ברוכים הבאים לפודקאסט השקעות של הבנק הבינלאומי. תודה שהצטרפתם אלינו. היום יש לנו פרק מיוחד מאוד, יחד עם מוטי אליאסי, שהוא מנהל קו לקוחות של יובנק ויובנטק. שלום מוטי.
שלום שרה.
אנחנו מתרגשים מאוד לארח מומחי בינלאומי מהשורה הראשונה, סם וכט מבלקרוק לונדון. סם מנהל השקעות בכיר מאז 25 שנה, עם הרבה ניסיון בשווקים מתעוררים ופרונטיר. סם ביקר מלמעלה מ-80 מדינות, וזה מביא לו פרספקטיבה ייחודית מאוד שאין הרבה למומחי שוק ההון. ועכשיו נעבור לאנגלית. Joining us today, Sam. Hello, Sam.
Hi, thank you for switching to English.
You're more than welcome.
Much easier for me.
Okay, Sam is the co-head of the London-based emerging markets and frontier team at BlackRock in London. 25-year career managing both long and long-short portfolios. Sam has visited more than 80 countries for BlackRock, giving him a uniquely rich perspective on how markets, economies, and societies evolve. We truly honored to have him with us today.
Thank you.
Not every day that we have a French lady, a Brit, and an American sitting in the same podcast. It sounds like the start of a really good joke, but in our case, it's a start of a great podcast. So thank you for coming here, Sam.
Thank you. Hopefully it will be lots of fun.
So Sam, 25 years navigating meaningful volatility with emerging markets. It's a major accomplishment. What has driven your long-term success?
I think several things are really important. Number one, it's the team around. It's really difficult to cover this range of different countries. There's about 194 members of the United Nations. And aside from the 20, which are viewed as developed, so countries like the United States, United Kingdom, we look at many of the remaining 170 or so countries in the world. And as you said, I've been to about 80 of them. And now, obviously, some of them are a bit small to invest in, but lots of them are really interesting. And what's been critical to us, other than the team, as I mentioned, is the ability to travel to these countries, to meet decision makers, to listen to what they're saying. They're not always honest, but it's important to listen to what they're saying, to meet the companies, the customers, the suppliers, the competitors, and then to leave those countries and be able to think with a clear head and to think objectively about these countries, whether they're going in the right direction, whether the investments make sense. And perhaps the most important thing that people often forget is the price that one is paying for these assets. It's not good enough just to buy something that looks good. The key point at any time within emerging and frontier markets is what is priced. And if things are good, but they're overpriced, one needs to stay away.
So what do emerging markets actually offer that developed market, or specifically the US, simply do not?
So the first thing to remember is that over long periods of time, there is no evidence that emerging markets actually outperform, definitely not on a risk-adjusted basis. So the key thing when thinking about emerging markets is to think where one is in the cycle. And it so happens that as we sit today, the United States has been outperforming for about 18 years. So since 2007, when as a Brit, I'll remind people that Tony Blair was still our Prime Minister. So it's a long time ago. So for the last 18 years, the United States has outperformed pretty much everything. But that wasn't always the case. If one went back sort of 18 years before that, and sort of went back to, 1990, for those 18 years, emerging markets comfortably outperformed the United States. So this is a deeply cyclical and volatile asset class. And I would suggest what emerging markets offer today, which they haven't necessarily always offered, is fairly cheap valuations, not overvalued currencies, which at some point they have been overvalued, the possibility of positive political change. And many of the leaders in emerging markets have been there for the last 20 years. And we're just used to the same people being there.
Very old people.
There are a lot of old people running emerging markets. In fact, the vast majority of emerging markets are run by men. In fact, almost all of them are run by men, which is not necessarily positive, who have been in power for 15 or 20 years and are older than 70, in some cases older than 80. And so my expectation is that we're going to see a whole new generation of leaders in emerging markets over the next 5 to 10 years. And also, it's just worthwhile thinking that the world really has split into three. in the last 3 or 4 years. We have an Eastern world, call that China, Russia, some of their allies. We have a Western world, the US, the EU, the United Kingdom, and the countries in between that are able to trade with both and attract investment from both. Those countries are likely to do a lot better than either the East or the West over the upcoming period.
This is what they already started to do in 2025. It's been a very nice year for the emerging market.
That's true, but it's not been that good. I mean, yes, they've done well, but they've done well from such a low base. It's like, coming from level 0 going to level 1. If you look over longer periods of time, as I said, there's still a lot of underperformance. And it's not that all emerging markets have done particularly well. What's done well this year has been countries that are somewhat related to United States tech. So the countries that have done really well this year have been Korea, parts of Taiwan, parts of China, not all of China. But large portions of emerging markets haven't actually done all as well as you would have expected. So it's not that everything is wonderful across emerging market. It's very important that all investors take a medium-term view with investing in emerging markets. Not everything is wonderful there, but I think we're at the right point in the cycle for investors to rethink about emerging markets and to remember they won't always underperform. And I'll just close with this. Anyone under 40 has never actually seen emerging markets outperform in their careers. If you think most people start working when they're 22, perhaps a bit older, that's kind of interesting because the majority of people working in finance in their careers have never seen emerging markets do well. And I think that's about to change.
As I just mentioned, the MSCI EM did better than the S&P this year. Do you think that this will tailgate, or do you think it was just 1 year?
I hope it's not just 1 year. I've been hoping for emerging markets to outperform for a long period of time. I genuinely think it's going to be a bit more sustainable this time, but it will be with volatility. Remember, 80% of emerging market stocks move 40% or more every year. So you're looking, as I said, at a really volatile asset class. And the worst thing one can do when it comes to emerging markets is forget that. So if I'm ever traveling to a country and my mother says, oh, that's a sensible place to be traveling, I get worried because none of these places typically are sensible. And when we invest in a country and we see a client and say, oh, that makes a lot of sense, you're investing there, I also get worried. For the same reason, one has to remember the volatility. I do think emerging markets are going to do better in 26 than the rest of the world. And we can see a range of different countries. It's not one particular sector, one particular region that's looking good. I think there's a range of different countries that both on an absolute and relative basis look quite good going into 26. But as I stress, there will be volatility. And the worst thing one can do in emerging markets is panic. And the old rule that goes back for 200 years in emerging markets is buy to the sounds of cannons. When things, there's a sound of war or problems, and sell to the sounds of trumpets when everyone is happy. And just remember that is, what one has to do when one thinks about these interesting countries.
Bumpy ride. You need to be ready for it.
Have to be ready for that and be prepared for you making an investment and the next day something goes horrendously wrong. And therefore, it's all about risk control, having portfolios that are deliberate, diversified and scaled, having exposures across a range of countries and not putting all one's money into the new great thing. And, perhaps a year or two ago, everyone was very excited about India, and India is a great place to invest, but at the wrong PE multiple, that is not the right place for people to be putting large amounts of money. Today, everyone's excited about technology, AI, and there's really exciting stuff to do there as well. But putting all one's money into that particular sector or one particular country is generally a bad idea.
So what other team would be interesting to invest? And also, maybe you may share with us an example of a market or a country that turned to be a success story.
So I'm going to take the second bit first. I think over time, all these countries are doing fairly well. And if I look at my so-called career for 25 years and I think of the countries and I look at whether it is what Brazil looked like in 2000, what India looked like in 2000, what China looked like in 2000, what Indonesia looked like in 2000, what Egypt looked like in 2000, any of these countries have changed a lot over those 25 years. And there have been some really good times to be investing and some atrocious times to investing. And I hate to point on any one country for the simple reason that when it comes to investing, one has to think about these countries as a whole and think at a portfolio or strategy level. Because, as I said, the worst thing one can do is I'm going to say country X looks really good for 2026. And people are going to go, wait, oh, that's 20, I should put a lot of money into country X, whichever one it is. And that's just not a good way of investing because something can happen. And the thing about emerging markets, which is very different to sensible countries like the United States, is that there are very, very few long-term winners, very, very few companies that can just make their own weather, companies that just can compound earnings over time. Because politicians change the rules arbitrarily, the countries' economies are much more subject to global crises than those in the US or EU. And therefore, any single country that I'm going to say today looks really good, something can happen in February, and I'll look really stupid for having said so. I may look really stupid for other reasons, but I'd rather not do so deliberately. So what's important for us, I said, I'll give you a range of different countries that I think are going to look interesting during 2026. I think Brazil is number one, starting in the West. Why not? It's pretty much never been this cheap. Domestic Brazil is at sort of a 50-60% discount to where it's been historically. There are elections that might see political change in the country. They've got the highest real interest rates in the world, and inflation is falling. And I think as inflation falls, that's going to be really supportive for the market. We can go a little further east. We can think about countries like the UAE, the United Arab Emirates, which is doing really well from some of those trends I described earlier as being a place that people from around the world can invest in. And the property market is absolutely booming there. We can look a little further east again and look at countries in Southeast Asia. So lots of different opportunities out there today.
And do you think that the emerging markets needs a strong developed markets in order to perform well, or they can, do it non-related to that?
So what's interesting is if 18 years ago I told you that the United States was going to, depending which market you look at, was going to go up 5-fold, 10-fold over the next 18 years, what were emerging markets going to do? You'd have said to me, well, they're high beta, so if the US goes up 5, emerging markets are going to go up 10, and if the United States goes up 10, emerging markets are going to go up 20. And of course, that's not happened. The United States has gone up 5-fold, 10-fold, and emerging markets have gone in price terms pretty much nowhere. So my assumption, my forecast, my hope, my guess, whichever one you like, for the next few years, is at a period of time where the United States may not collapse, but may just go down a bit from a very overvalued level that some United States stocks are. And I think as some United States stocks fall, it will cause people to sort of think about opportunities elsewhere. I'm not a believer that the US dollar is going to crash, but I do think that just a little bit of weakness in the United States dollar, or perhaps no appreciation in the United States dollar, will cause people to think about investments around the world, and especially emerging market investors that have taken money out of their own countries over the last 18 years and put a lot of it into the United States, may actually bring some money home. And just bringing that money home may be actually rather good for those emerging market countries.
Okay, so since you are here, I have to seize this opportunity. Okay, and I ask you, after traveling to so many countries in the globe, what would be your top recommendation for traveling?
Oh, for holidays? Oh, for traveling. So I've been to 80 countries for BlackRock, about 130 overall. So my top countries to go for, like holiday, one should never confuse holiday with investment. It's very interesting. There are lots of investor conferences in Thailand. And historically, there were very few in Russia.
It's very important what you say.
Yeah, exactly. Very few historically in Russia because, Novosibirsk in February is not a place that you're going to attract investors to. That's historically the case. So if I was going to pick a place to go, I would say Rwanda is an unbelievable country. Djibouti, a place that very, very few people have been to. And Uzbekistan. I'll leave you with Uzbekistan because if there was one place, I haven't touched on it at all, like a real frontier market that people aren't thinking about today, which has gone through some pretty big political and economic changes. And also many people here in Israel have some connection to the country. from sort of Bukharim and other histories. It's a place I would strongly recommend traveling to. I think there are going to be some more direct flights actually from Israel in March, straight to hopefully. So that's a cool place to go. And also, I think we could see some really interesting changes on the economic side and in the stock market there. So and perhaps we haven't done one in Latin America. So I think Panama is a nice, fun place to go to. So that's giving you a spread around the world to look at.
Wow, thank you.
Sam,
I have to make so many plans now.
Sam, there is a lot of focus on tech hardware today. What is like a good trade or a good place that you can find those investments?
I think it's very difficult. I think it's also worthwhile remembering that, as you said, tech hardware logically should be not a great place to invest. If one thinks about it, there is a lot of innovation. So the chance of a company being a winner today and being a winner in 5 years' time is actually fairly low. It's not like chocolate or fizzy drinks or detergents, where it's likely, not certain, that the type of detergent we buy today is probably what we're going to be using for washing purposes in 5 years' time, and it will be the same company making it. That's less likely in technology in general, because things change. And then, remember, tech hardware is highly capital intensive and very cyclical. So if I'm looking objectively at this and I'm looking at a sector where there's a lot of change in terms of leadership, it's highly capital intensive, highly cyclical, this isn't actually a great place to invest. Now, it so happens that we sit in an environment today where people are really excited because of AI and various companies in the United States and Taiwan and around the world that are benefiting from this. But I would suggest that if I took 10 tech hardware companies today, there will, of course, 10 big tech hardware companies today. I would be fairly confident to say that if we sit again here at the end of 2027, a fairly large proportion of those 2 years from now will have gone down a substantial amount from today. Not all of them. And there'll be one or two companies that have done fabulously. But statistically, this is a bad place to invest in because of the reasons I suggested.
Wow. Sam, thank you so much for joining us today. This was truly fascinating. And we deeply appreciate your insights, your experience, and the colorful global perspective that you shared with us today. Thank you so much.
Thank you. And sorry it was not in Ivrit.
Thank you so much.